Want to welcome everyone to a joint conversation about the Emergency Board Consensus Revenue Forecast. Really grateful to Tom Cavett for joining all four committees today to talk through the forecast. Given that we have some people joining via Zoom as individuals and some people in their committee rooms, I think what would love to end how deeply Tom is able to go into individual topics when prompted. What I'm going to ask is for Tom to give sort of the full overview that you're interested in, Tom, for maybe 15 minutes or so, 20 minutes or so, whatever feels right. But we are pushing up against 4 o'clock already here. And then we'll give each committee time for questions and would ask the chair of the individual committees to be who would call on the folks in their committee. Does that make sense to everyone? So we'll go first and then we'll sort of move from committee to committee for questions. Senator Cummings, I'll ask you to actually be the person who would call on Senator Chittenden and Senator Rahm Hinsdale when it's your committee room's time for questions. Does that sound good? Seeing no objections? Hello, welcome. Glad to have you here.
Thank you very much. Good to be here. And this is a little odd even for a Zoom configuration because the other committees are behind me.
Yeah.
And so I'm speaking to one committee here, but that's fine. I guess the camera.
I want to make eye contact.
So that's it. Anyway, I
Hmm.
do want to mostly leave time for Q&A because it wasn't like there were dramatic changes in this forecast. It's not radically different than the July estimate. The economy is doing a little bit better than we had thought. This notion of a soft landing is coming into focus in a way that I think a lot of people didn't think was possible. And the soft landing being the Fed is purposefully trying to slow down the economy in order to slow down inflation. And to do that usually pushes up the unemployment rate significantly. And they've been able to, at huge increases in interest rates, inflation has come down appreciably. And unemployment has not really gone up much at all. So that's the idea of it being a soft landing. It's important to understand that when you're flying, to take that analogy a little farther, when you're flying in an airplane, it's never good to make a forced landing. And that's what it is. It's not like, oh, great, we're having a soft landing, everything's great. We're still talking about a significant slowing in the economy, a significant slowing in revenue. We have available general fund revenues declining in fiscal 24. That's a rare event. And they're going to decline a little bit more in fiscal 25. That's even more rare to have 2 consecutive years like that. So it's not like, happy times, but relative to expectations back in July, things are looking pretty good. And just to take the flight plan analogy a little bit further, it's the runway's in sight, but the actual landing is the hard part, and we're not there yet. So a lot could go wrong when the economy's declining and slowing like it is. It's just a lot more fragile to exogenous shocks that could tip it, down all of a sudden. And there are plenty of exogenous shocks out there brewing. The Middle East conflict comes to mind with all sorts of escalations possible there. You see the impacts that the Russia-Ukraine war has had on the economy. When you look at inflation by, individual component, you see big differences in things that were affected regionally by that conflict and the way they impacted supply chains and prices. And so there's a lot of vulnerability, but in general, things are a little bit better than they looked 6 months ago. And we have a little bit more revenue than we expected for the most part than we had 6 months ago. So the first 2 pages of the document that the, the handout just sort of summarizes some of that. But to just cut to the revenue impacts on page 30, there's, a table that by fund looks at the changes, and overall across all three funds, there'll be about $33.8 million more than was expected in July in fiscal 24, and about 13 million more in fiscal 25, 16.5 in 26, and then 6.5 to 7 in 27 and 28. That's not a big change given the base volumes that we're talking about with total revenue coming in. But at least except for the transportation fund, it's in the right direction. So that's kind of the takeaway from it. There's a lot going on. I can talk about individual funds and all sorts of things. It was a particularly long emergency board meeting today, at which these numbers were adopted, and it's hard to know like when there's going to be a lot of questions and when there aren't. But that's, I think, what we're doing this for. So I'd like to open it up to questions, really, and from all the various committees might take a little while.
Yeah, so what I'm hoping to do is two people in this committee are both going to ask questions, and then if you could answer both questions at the same time. It doesn't have to be in the same paragraph, but I think that would be a more efficient use of everyone's time. And then I'll go to another committee and they'll have sort of two questions and then you could answer.
Oh, I see. Okay.
Does that make sense?
Sure.
Okay.
Yeah, let's try
Might
it.
require a slight bit of memory, but I think it'll be efficient. So remember, everyone, we got two questions for the whole committee, so love your neighbors. Peter and Jim.
I've talked about this. It's come up in our committee, and the broad rubric is something of a reset in the underlying glide path. So we've come off all the federal spending and so on. There's been a debate and speculation that once that is dissipated and it's going down slowly, we will be landing in a place that we were not at before. And I remember in a presentation you made, I'd say a month ago, I asked specifically about in the technical jargon, the capital output and labor output ratios, given all the investment money that has flowed, that might have reset, if you like, many of the model parameters with which you work. And so that's my sort of broad question. And how will we know whether there's been a reset, and when will we know? So you can do your business with greater accuracy in a new environment.
And then Representative Masson.
That's a
Wait,
big start. Yeah, all right. I'll try to remember all the, okay.
Mine's much more simple, Tom.
Good.
First, I heard you say we have declining revenues and more declining revenues the following year.
In the available general fund, yeah.
Yeah, available general fund, but looking at your chart here on page 30, I guess this is one relative to the other. And so with the exception of transportation increase, and I guess that's increase compared to what, meaning,
July.
okay,
Yeah, so if you look at the tables,
yeah,
at the very end, there are a series of tables, and you go to the one on the available general fund, which is on page 39.
okay,
And you look at fiscal 24, it's minus 4.2%. Now, after we've added the money that's on that table that you're looking at, and then minus 0.8 in fiscal 25. So 2 years of less revenue, even though relative to July, it's a little bit higher.
that makes good sense. I just didn't want to quote something that I didn't quite understand outside the room.
Yeah.
Thank you.
So now let me take the tougher question, because this is, and I don't want to spend too long on it because it's really involved. It is the pandemic has affected everything we do in analyzing revenue, in understanding relationships in the external economy to revenue, and the way those things work. And we try to boil all that down to math. And those relationships are what inform the models. And there are things that are just off the charts in those models that we try to understand and that affect every single sector of the economy that drives revenues. And I don't know how long it will take before those relationships are fully understood. But there's hardly a report that comes out that in some way isn't influenced by that. And then it also makes forecasting harder because you don't have a precedent for a lot of this stuff in history. And almost all the models are looking at historical relationships. And if those are not valid, then you've got blind spots as to what could happen. You can hypothesize, but it's hard to have the same precision around that. Part of, I think, though, economic forecasting, I think is wrongly supposed to be about perfection of foresight. It's more understanding relationships and where you don't understand them, identifying those, and then responding to what actually happens. And you can respond much more quickly if you're close or if you framed it in a way. And there are lots and lots of those kinds of things out there. Just for an example, let's take interest income, which is now gigantic and a huge part of the budget. There's a chart towards the end of the deck on the outstanding cash reserves that we have. Let me just get the page number on this because I'll reference a couple of things in it. That would be, okay, page 32. And so this is the average monthly state cash balances, and they have this daily. It starts out as a daily time series, and this goes back to 2004, which is great. We have enough history. We can start to look at things. So this balance times an interest rate that gets you a yield tells you how much interest income you'd have. That seems pretty straightforward, right? Well, the first thing we do to any set of data like that, you can see the little thin blue line is the raw data that we get from the treasurer. And it sort of moves around in kind of erratic ways. And you can see that they're kind of similar erratic ways. And that's the seasonality that's in. There are certain times of the year that we get revenue and that we spend revenue that aren't perfect, but that are kind of regular. So we run it through programs that's seasonally adjusted. And there's a fair amount of art to that also, but that allows us to look at it on a basis saying, all right, even though it's April or even though it's, November, that number there, it might look low, but it's really pretty good for November. Or April looks really strong, but guess what? That's not too good. At the very end of this chart, you can see where that's happened. The dark blue line actually goes down, but the seasonally adjusted number is quite a bit higher. And it's the last observation. Now you need a few more before that, you would use that as something actionable in a model. But what we model is that seasonally adjusted data. The pandemic really skewed a lot of the government data in terms of seasonality also. And so even when we get numbers on inflation and things like that, they're often skewed in some way by the way the government's seasonally adjusting. So these sorts of things permeate all of the universe of data we have. So I don't know. I mean, the answer to the question, it's been fascinating in a technical way, just as an intellectual challenge. It's been way more interesting being an economist now than it would have been in just sort of normal thing. And you understand relationships when they really get stressed, so you look at, all right, well, here's what should happen, but guess what? It didn't. And why? And so you get a deeper understanding of how the economy works. But there are a lot of things that are still buried in the data that we don't know.
There's that, there's that blessing curse, may you live in interesting times. And
What's that?
may you live in interesting times.
Yes, okay, there you go.
Yes.
Yes, that's right. That's right. So I don't know how long it'll take, and I do think there's going to be uncertainty. We made changes to the interest forecast here, just getting this data moved around, and it's detailed in the text in there, but it moved around $5 or $10 million year to year. Some years were lower, some were higher. And then the amounts that went to the education fund versus the general fund, that also changed just based on a little bit more information. And we're still getting more from Treasurer's Office. The yields are the next part because we apply an interest rate forecast to that. But the yield is not always exactly what the interest rate forecast would be. And there are lots of different interest rates you can use. So the Treasurer's getting a pretty good return, but anyway, that's the process. And yes, it's a big part of what's happening, and it's not settled yet at all. Okay.
So Senate Appropriations, wondering if you all in that room have questions.
We do have a question. It's going to be asked by Senator Westman, but I think it's a question that's really been articulated by a number of the committees. So for the sake of time, we're going to have Senator Westman ask the question on behalf of the committee.
Thank you.
So the line that I think that is bothersome to us is, despite crippling mortgage rates, home prices remain elevated. And I think for us, a lot of us middle-class families are in this pinch that the real estate is up and the interest rates are high, and the people that are being pinched out are middle-class families. Where do you see interest rates going? What's any idea what the Federal Reserve is going to do? And where do you see all of that ending up, and what's the trends?
And the last part was what, Rich?
Timing.
Timing, okay. Well, the Fed told us in December that they're going to be cutting interest rates in 2024, or they hope to. But that's, for the Fed to even be that specific is pretty radical statement. So the reason they felt comfortable enough in that is that they saw the inflation numbers coming down. And there's a chart like towards the front on page 4 that shows the CPI, which is kind of the interest or the inflation number that gets probably the most coverage, but it also shows the personal consumption or consumption expenditure price index, which is what the Fed really looks at. So both of those things are on page 4 of the handout. The solid line is the CPI and the dotted line is the PCE. So inflation, peaked June 2022 at 9.1%. And now it's in the last 6 months, it's been between 3 and 3.7. The read in November was 3.1. And that's what the Fed had, the information they had when they said they were things look good enough that they're probably going to be cutting rates going forward. The December read wasn't quite as good, it was 3.4 in the CPI. But the PCE is what they look at, and that was 2.6 in November. That's the latest available data for the PCE because it doesn't come out as in as timely a way as the CPI. So I think in a couple of days, though, we're going to get a new reading on PCE. So that'll be really important to when and how many times and by how much the Fed cuts interest rates. So the expectation is that interest rates will be coming down, but probably not till the second half of 2024. There are some people that, when they announced in December, market was euphoric, big gains, and lot of people were saying, oh, by March, they're going to start cutting and da, 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 da. It's data driven, and I don't think as an economist, you can't take a single read and really think, oh yeah, that's real. You need supporting data for a period of time. I would be surprised if it's before May, maybe June or even later. And it depends how it comes in. If that 3.4 goes up or, stays like closer to 4 than 3, they may hold for longer. So that's kind of the wild card in interest rates, but we do expect them to come down, but they're not going to come down real fast. It'll probably be 25 basis points per meeting when they start doing it. But that's all eyes are going to be on that. The feedback loops into housing are complex and huge, but the price increases, as you say, for a middle-class family trying to buy a house are horrendous. But for a middle-class family who owns a house, it's fabulous. The price of your house goes up. That's, for most middle-class families, it's your largest single asset. And if that's gone up 40% or 50%, that's good news. The problem is if you try to realize that gain by selling it and moving to another one, if you have a mortgage on that, it could be 3% or 4% or something like that. So you sell it and you want to move into something else, it's going to be high priced and you're going to be faced with really high borrowing costs. So what happens? You don't move. And that's what's happening right now. So the market response to high prices is more supply. Where do you get the supply? People move out of the houses that they're in, and speculators start building houses because they see that they can make a ton of money building houses. That's a normal real estate cycle. You talk about how the pandemic has skewed stats. We don't have that at all. So here you have high prices. There was no chance for a big run-up in supply because it didn't last long enough. The signals to the market that there was a shortage didn't last long enough for a lot of new supply to be built. And all of a sudden you have high interest rates, so that's choking it off and making it harder, and you don't have people moving. So reducing interest rates will be huge in terms of helping unthaw what's happening in housing and better meet supply and demand. It's important to note that, this was discussed in the emergency board, that the housing shortage is both relative to the number of people that, household formations and the like that would typically occupy a house and the income they have. If you look at poorer countries, you'll see many fewer units of housing satisfying the demand for, given the number of people that they have. So it's an income thing as well. Our expectations for housing are relatively high globally. But getting it to match is difficult because you do have a lot of people, older people especially, that are in homes that are larger than they need, that have unused space, but moving is a difficult proposition with interest rates as they are.
Thank you.
Does that answer it, Rich, or start to?
Thank you. It starts to, but
Okay.
it's just depressing right now for anybody that is in that middle. They're in the squeeze. And if you're in a house, you can't sell it because you can't find anything new. And the interest rates are over the moon for you.
And so we squeeze the middle class, as Richie described, and still, no matter what the Fed does with interest rates, we're still, the top 1% is still managing to profit from that, I think. And so that's an interesting part of the puzzle.
Well, sure, there are big income disparities, and the farther you go on the income side, you may need housing in terms of what other people think you need. But with limited income, you're even further from it. So in terms of negative impacts, you scale that based on income quite directly.
Senate appropriations, do you have Senator Kitchell, do you have another question or should we move on to a different committee?
Looking at the time, I think we ought to, keep going with the other
Great.
committees.
Okay, thank you. Senate Finance, Senator Cummings.
I am not seeing any questions in finance. Oh, we do, Senator Bray.
Never say that out loud.
I know.
Tom, can you say, housing has been a main preoccupation and understandably so, but I'm wondering, given the market forces you're talking about, to what degree Vermont has the ability to influence, housing? And I'll stop right there.
With state public policy, it's fairly limited. I mean, if you look at the cost of a new unit and how many units, might be needed, it's really limited because you could spend vast amounts of money and really not directly build much. I think, what you can do is provide safety nets and, help at the bottom and also make it easier to build places. And, there's been a lot of apartment construction in the state actually, and nationally too. That's a sector that's where there's been more supply added or soon will be more supply added. Some of those projects are still under construction. But I think you need to look at all the different ways that the state could make it easier for supply and then also help the segments of the population that are most severely impacted. That just, really don't have any housing or, but it's difficult because there are a lot of trade-offs and you can't spend your way out of this at the state level. There aren't the resources to cover the problem.
Sure, and on this, people talk about the American dream, own your own home. But can you say a little bit about, as you look at Vermont, how our policy prefers home ownership over, apartment dwelling or vice versa?
No, I'm not really. I haven't taken an in-depth look at our state policy. I haven't been asked by Joint Fiscal to do virtually any policy analysis around housing. So I'm not. I don't really have any perspectives on that. I can tell you about how the economics of housing works, but not current state policy.
Thank you.
Thank you.
House Appropriations.
Thank you. Anybody from the committee? Questions? Representative Dolan, please.
Thank you. This is very interesting and truly appreciate your time here. My question is in the realm of the inequities or the wealth gap that's building. And I'm concerned about fundamentally the instability that kind of wealth gap can play out in the economy across the state, certainly across the country. Do you have any comments on that topic and suggestions or recommendations for us to really more strategically address this growing gap?
Yeah, that is an issue that since I started working for the state has been a question that's been posed. And it, like some of the really big issues like demographics and housing and things like that, is not something that state public policy can resolve. It's not like you're going to have a huge impact on that, but there are things the state's tried to do over the years with progressivity in its tax system and things like that, that can make a difference and recognize that that's going on. Interestingly, in the pandemic, it was one of the few times in the last 40 years where the lowest income and wealth groups, and it's large, like the lowest 40%, but even as you get down into smaller groups, that wealth actually increased more among those groups than it did at the high end. So there was actually
On household purchase.
growth, so percent growth and the share of total. So their share of total wealth went up. The very top, and the way the Federal Reserve collects these data is it's a top 1/10 of 1% in their wealth data. That actually went up also, but the bottom went up by their share. Again, it went from like 2.5 to 3%. All right. And this is the bottom 40%. So that's not, I mean, it's dwarfed in numbers, but still that was significant. That was a significant change. You got a lot of credit card debt paid down with that. You got a lot of asset growth with that. That was one of the most dramatic. Just when you look at economic numbers, and we're talking about that, that was a dramatic interruption in what had been a continual separation between top and bottom. And the latest number, so net worth actually declined. It peaked in the first quarter of 2022 and then declined in the balance of 2022 and into 2023, but then started growing again in 2023. And probably our fourth quarter numbers that aren't out yet, 2023, will show that its net worth in aggregate has grown above that prior peak. That's all assets lumped together, housing, everything. But the latest numbers show that it's been more top heavy. So that last little bit of growth has been more traditionally like the high end. The other place we look at this is in household income that the census publishes. We use that to forecast income sensitivity. That's why we take a close look at it. And unfortunately, it models very well with overall income distributions. And there you see data through 2022 show a continuation of the same thing that's been happening, for 40 plus years. So I think it's a really tough policy area, but wherever you can, if you're cognizant of that and you can have a choice, there are things on the margin that you can do to help, and providing a safety net at the bottom is the other, just in terms of extremes, the other thing that government can do.
House Appropriations, do you have a second question over there, or shall we?
Members, I think we're good. Thank you
Okay.
for asking.
And that, seeing no hands from other committees, I'm going to thank you so much, Tom, for your time and the full day of commentary and reports.
Sure. We didn't talk about the T fund, and that's okay because tomorrow I am going to meet with both transportation committees because that's a problem area just in the forecast. It jumps out. But thank you all. Now I can only see you by turning around and you get the back of my head. Thank you very much, and thank you to all of you here. Yes. Thank you.